The Fed raises rates by 75 basis points. Another new low occurs in the S&P, Dow, NASDAQ, and Russell 2000. Crude oil backs off from its recent highs, getting below $107 a barrel. Gold's still stuck in a trading range, trading around $1,840. 10-year yields were trading around 3.5% prior to the FOMC announcement. And after the Fed raised rates by 75 basis points, the 10-year yield closes the week right around 3.25%. What's next for all of these markets? Well, I sat down with Managing Director and Chief Economist at CME Group, Blu Putnam. Blu shares with us his thoughts on the latest Fed announcement and why he believes the markets reacted the way they did. Blu also lays out some key data points that traders should be watching that may impact Fed policy. Today's podcast is sponsored by CME Group. Whatever the obstacles, CME Group provides the tools that global market participants need to manage risk and capture opportunities. With 24-hour access to futures, options, cash, and OTC products across all major asset classes, you can drive your strategy forward with confidence and precision. CME Group, where risk meets opportunity. What are your initial thoughts on this latest FOMC meeting?
Well, it's a fascinating, like you say, a fascinating period. To me, there were actually two critical days. It was Friday, June 10th, that we got the CPI report. And, I wasn't too surprised with the number, but a lot of other people were. And it wasn't the headline number that got everybody upset. It was the month-over-month number. So from April to May, we went up 1% in consumer, price inflation. And what that did to the market is it changed the narrative. The narrative said, wow, inflation really is in control. And then what the market responded with is federal funds futures started pricing in 75 basis point increase for the Fed's meeting on June 15th, and then another 75 for the Fed's meeting at the end of July. So then we get to the Fed's meeting. The other day was critical. And you got to say, what's the Fed going to do? They told us 50. The market seems to be saying 75. What's happening? Well, they went with 75. And, what that tells me is that the Fed's really trying very hard to get the narrative back that the Fed understands what's going on. But if you believe that narrative, then you also know that they're going to go higher faster. And that brings on expectations that the economy might slow down a little more than you thought. And so we had almost no market reaction in the hours after the decision because they just did what the market thought they were going to do. But then the next day, we got a big market reaction when people did their homework and said, oh, this is a more hawkish Fed. I better rethink this. So that's my quick interpretation.
You mentioned how the CPI played a big role in going with 75 basis points. I'm curious what you thought about the University of Michigan number as well.
I don't think the sentiment data is as important. I mean, I look at the Michigan and I look at the Conference Board sentiment and, there are various sentiment indicators out there. Sentiment indicators are surveys. And, I'm an economist and I like to see, I want to know what's happening with the real data. I want to know what the markets are doing. I don't want to know what you're telling me. So I think the sentiment data added to that narrative, but I think it was the inflation data that really changed the way people were thinking about whether the Fed was behind the curve or not behind the curve and that kind of analysis.
Do you think that the Fed is behind the curve?
Well, a very good friend of mine who's a really superb economist has an analogy that suppose that you're in a convoy of cars, and this convoy is actually the inflation rate, and the convoy is picking up speed, but you're not. So you're falling a little bit further behind. So now you have a choice. And this is the framework you have to think about what the Fed had to decide. Because you can pick up speed and even accelerate and catch up. And then once you catch up with it, you actually can lower rates. Or you can like pick up speed a little slower, but then it might take a long time to catch up. So I think that the Fed made their decision that they had to pick up their speed, that they couldn't fall further behind that narrative that inflation was taking over, because the Fed really doesn't want inflation expectations to get ingrained. And they're not yet. If you look at the markets, they're not ingrained. They're worried about them, but they're not ingrained. So, the Fed, I think, made that decision that they better catch up with the narrative and try to take control of the narrative, which is what Jay Powell is trying to do.
Do you believe that he did gain control of the narrative by going 75 basis points?
I think it's still up in the air, and you can see that in the volatility of the market. There was a great book written in the 1920s by Frank Knight about risk and uncertainty. And, risk is when you can kind of put a probability on things and you really understand a little bit about the risk you're taking. Uncertainty is when you really don't have a clue. Well, we're in a lot of uncharted waters with what's going on. I mean, the Fed can't control the Ukraine war. It can't control oil prices. It can't control that we haven't built refineries, so we're short of gasoline, diesel, and jet fuel. The Fed can't control the pandemic and that we bought more goods and now we're going to go back and buy more services. So, the Fed's handicapped here, but it does have a tool. It has interest rates and it can affect demand. And I think they realize they have to use that tool.
Put your Fed chair hat on and looking for this July, I believe it's the 27th meeting. It's the last one really for, I think it's almost 2 months. I think the next one's in the end of September. What do you think the Fed does in this next meeting?
Well, I don't know what the Fed's going to do, but I do know that the federal funds futures market is telling us it's another 75 basis points. And the Fed, Jay Powell at the press conference said, well, we're going to consider that 75. In fact, he kind of, if you were putting probabilities on it, he made it sound like we'll probably do it unless we get some other information. So the guidance and the markets, I think, are interpreting 75. Now, it's interesting to see the equity market and the bond market, because Fed funds futures says, we're going to get another large tightening move. The 10-year has actually declined in yield, higher prices slightly. And that's because what you were talking about is that, the equity markets are worried about a recession. The 10-year is worried about a recession, and that would help contain inflation. So if you're in the Treasury market, the 2-year Treasury note is responding to what it thinks the Fed's going to do over the next 2 years. And the 10-year is saying, wait a minute, I'm a little worried about a recession. I'm worried about these equities going down. I'm going to behave differently than the 2-year. So it's a pretty fascinating market out there.
I know that you can't predict what you think the Fed will do, but the data points that they're looking at that will help them make their decision. So between now and then, what are the things that traders should be looking at in the data that comes out that could possibly sway the Fed to do more? Because honestly, I would ask you what would sway them to do less. I don't know that there is something, but what do you think the traders should be watching for on the data side of things to see where the Fed may lean?
Well, let me start by telling you what they shouldn't watch. They should not watch the GDP data. The Atlanta Federal Reserve produces, based on current data, an estimate of the second quarter. It's currently sitting at 0. First quarter was slightly negative. I don't think the Fed's looking at that data. And the reason they're not is it's not in their mandate. Their mandate is encourage full employment and encourage price stability. And the jobs market, which got a lot of attention at Jay Powell's press conference, is doing quite well. Now, we know that's going to change a little bit for several reasons. With equity markets in a downdraft, with their issues in fintech and cryptocurrencies and things, we're going to see a few layoffs, but, they're not that huge. We may see a few layoffs in the housing market just because, mortgage rates are a lot higher. So the labor market is probably going to slow down a little bit. But that's the data that I think the Fed is watching most closely to decide if things are too hot or not too hot, and would determine, because they've seen the inflation data. The inflation data says you got to move faster. And now you got to weigh that against the employment data that will come out in early July. And then after that, the GDP data, I don't think makes a difference.
Blu, you look at the data very closely. You watch the markets every day. What is the data and the markets telling you about the U.S. entering a recession?
It's telling me that it's a flip of the coin, a mixed picture. It's not inevitable. I'm going to go back to a, driving a car analogy, but when the interest rates were near zero, the Fed had its lead foot on the accelerator. By the end of July, we'll be roughly at a neutral federal funds rate policy, pretty close to neutral anyway. What does neutral mean? Well, if you're driving a car, neutral means you're coasting. Coasting does not put you into a recession. So I think we have to see what happens to things in the second half of the year, early 2023, to see how much more aggressive the Fed might decide to be or not. But given what's happened currently, we're not. I would not make recession my base case. And even the equity market, I've been talking about it looking at a recession, but what it's really looking at is margin compression. Input prices are rising, labor costs are rising, and demand is not rising. And so they're going to, the equity market has to readjust valuations. And of course, bond yields are higher than they were 3, 4, 5 months ago, and that means lower valuations. So the equity market downdraft can be explained without talking about a recession.
So you think that the Fed has the opportunity to possibly have a soft landing then?
Yes. The opportunity, you phrased that so well.
Yeah, because it's going to depend on what they do reacting to the data. I mean, this is why I say I don't ever really look at dot plots, because when a market and data is coming in and changing the way that it is, I don't see how they can perfectly plan this to know that they can achieve that. I think it's going to depend on what they do reactive to the data, right? I hate to say that they're going to be reactive, but isn't that what they are doing? Or am I wrong?
Well, the Fed advertises that it's data dependent. So, I mean, they really are. But there's so many things that they don't control that could change. I mean, the Ukraine war situation could change. The weather, it's been pretty hot in the Corn Belt. It's getting really hot in Europe, which is going to drive up their natural gas prices and electricity prices. The fact that the Fed is well ahead of the European Central Bank and Bank of Japan means that, the dollar has been on a strengthening trend. I don't know if that'll continue, but the strength of the dollar actually helps fight inflation. So there's a lot of things going on that will influence the data that goes beyond, what they've done. And they'll look at that very, very carefully.
You hear a lot of people say that inflation is sticky. Do you think inflation's sticky?
No, I think inflation expectations are sticky. We went 25 years with virtually no inflation. And even now, most people aren't looking for a lot of inflation. They're looking for more than they saw a year or two ago. But inflation expectations are hard to get going, and they're hard. And once they get up there, they're really hard to depress because, back in 1980, 82, when Volcker took interest rates when he was head of the Fed to 20%, he really beat inflation. There was a very serious inflation, 10% a recession, 10% unemployment, and inflation went right down quickly. But in expectations took about 15 years to catch up. So it's not inflation can move around more quickly than you think, but it's the expectations that are sticky. And that's what the Fed really wants to fight. It doesn't want those inflation expectations to get stuck at a high level.
I want to talk about crude oil a little bit. And you've seen it come down the past few days. Crude oil is by far the market that I would say touches every consumer that everyone's watching. Of course, interest rates as well. But when you look at other markets, I think that crude oil is by far something that everybody is watching and everybody is feeling. What do you contribute to as the main reason why crude oil prices remain so elevated?
Well, I mean, it's the Ukraine war. But we are at maximum sanctions. That is, the EU not all the sanctions have gone into play, but there are no more new ones to be announced. They've done pretty much all they can do. And so the oil market now probably does not have another shoe to drop. The only question for the oil market is, am I going to get new supply from somewhere, or am I going to get new or not so much demand from somewhere? Well, if you look at the what's going on with economies around the world, you're going to get a little less demand. So that would take the oil prices, ever so slightly lower. On the supply side, the swing producer is the U.S. shale guys, and they're not growing much. And that's because while you're looking at the spot price of oil, they're looking at the 2-year price of oil that they need to hedge. And the 2-3-year price of oil is like 30% below spot. So their cost of hedging is very high. Their input costs, sand, steel pipe casings, skilled labor to do the wells, it's all very high, and it's not as easy to get financing as it used to be. So, supply isn't moving up much, but what's happened in the last week is that our expectations of demand moved down just a teeny bit. But the other thing going on in the oil market that affects consumer inflation is, the U.S. hasn't built a refinery in a couple of decades, and we've expanded a few of them. But, the problem is with gasoline, diesel, and jet fuel and heating oil, which is diesel. But it's, crude oil is actually not the problem.
Let's go to market reactions to the FOMC meeting. I've always said day one is the overreaction. Day two is the reaction to day one. And then day three tells us really what we know about what the market thought about what the Fed meeting really told us, what it told the markets. And, day one was interesting to me this time because day one, I felt like it was a really good win for the bulls in the U.S. equity markets. I saw, when I was looking at the 2-year, 5-year, 10-year, they really, in terms of yields, didn't go too high like you thought maybe they could really run. I think they kind of just settled down and actually came down a little bit. They're down as we sit today. And equities really didn't do much to the downside and really stabilized going into the close, maybe a little bit of sell-off. And you looked at everything else, and I thought, you know what? As a trader, I think that the markets are going to somewhat be calm here, and maybe we have a sideways to grind higher in equities. Maybe the Fed brought some, I don't know, I think just basically calm the markets, feeling confident that the Fed is on top of this. And then the next day happened, and you just got the markets got creamed, and today we're back as we record here on Fridays. We're at lows again. But what's interesting, Blu, is yields are not going up. Crude oil has actually come down. I would think that's a positive, right? I mean, gold is really just flat, but equities still can't hold a rally. What are your thoughts on that?
Well, you characterized it pretty well. So on Wednesday, the Fed decision, the Fed did what was, in terms of the 75 basis points, they went up. That was what Fed Fund Futures said might happen. It happened. So you didn't get all that big a reaction. Then, you sleep on it and you say, well, what does this mean? Well, if you listen to the press conference and you think about it, it means we have the Federal Reserve moving faster than you thought. They're much more focused on making sure that we know that they're going to fight inflation. And so the risk of a recession and a slowdown went up. And the equity market reflected that on day two. And then day three, all we're doing is bouncing around.
Yeah, and I mean, I look at this from a trader's perspective, and I just feel like if the market can't rally with crude oil coming down and you've got yields not going up right now, they've just kind of stalled. I mean, they're not really backtracking too much, but they have a little bit. Equities, I think, just continue, from a lot of the macroeconomists I follow, think that we're just pricing in a very deep recession, or they're looking at, I don't know. I mean, just what do you think the main reason really is that equities can't even respond or get a rally when you have some things that actually would help them?
I don't think we've finished recalibrating equities for margin compression. There'll be some company sectors that have pricing power, but inflation's going to last a while longer. You don't build a computer chip factory in a year. You don't solve shipping costs in a year. I mean, they are off their peaks and things like that. But these supply chain disruptions, what's happened in oil with the Ukraine and with wheat in the Ukraine, you don't solve these things in a year. And so, equities have to deal with the fact that companies aren't going to make quite as much money. And that assumes the economy is still growing. So if you like on Wednesday realize that maybe the economy is not going to go quite as fast, you take another small haircut off your equity. So, but let me go back to what I said earlier. We're the difference between risk and uncertainty. We're at a period where uncertainty is exceedingly high on lots of fronts, and so that just makes you overall more cautious. But there's definitely the opportunity here to say, okay, we've done enough. I mean, we've done the bear market where we've gone down 20% on S&P, we've gone down more than 20% on Nasdaq. We paid a pretty good price, and we kind of know what the Fed's going to do now. So you could make a case, not that I would, but you can make a case that you could form a base here.
Exactly what I've been thinking. And like I said, the market's proven me wrong the past couple of days just because every rally still met with sellers. But obviously next week we could see maybe they start to see a bid come in equities and hold up just for the reasons that we've talked about. The last market I want to discuss is gold, because this is a market that everyone looks at in this type of environment. I mean, this year, I've seen gold talked about a lot. What are your thoughts on gold?
Gold used to be thought of as a really good inflation hedge. But gold doesn't bear any interest. So if you're in a period where you really think the Fed is going to fight inflation with higher rates, then that's offsetting for gold. And, you're going to trade in a very wide range. And that's kind of what gold's done. So it's very hard for me to make a super bullish case or a super bearish case when I look at my different scenarios. And it's really that, sure, in an inflation period, you want to own hard assets. But in an inflation period where the interest rates are rising, there's an offset. So, sorry, it's a flip of the coin answer for gold.
Well, the technicals are proving that. We could always look at the macroeconomic side of things, but when we all go to the charts to look to see what the technicals tell us, and gold has just done nothing. I think it's pretty much flat for the year. In the past couple of weeks, it's been up or down maybe a couple of percent, and it's just not thriving in this type of a market. But it's not getting crushed either. I mean, look at crypto. And I remember when everyone said that Bitcoin was the hedge against inflation. That didn't work out so well.
No, that did not work.
I mean, I guess we did mention Bitcoin. I mean, any thoughts on Bitcoin or maybe Ethereum?
Well, those are markets that most of the people that trade those markets trade on technicals. Not everybody, but it's, the thing that I observe in those markets is that they have a lot of kind of an insular ecosystem. The different currencies are actually linked to each other in various ways. The crypto exchange trading platforms often buy services from other fintech firms and invest in each other. And I don't want to make too big a deal of this, but what that means is that when things go really well, they go up too fast. And when things go not so good, they go down too fast. So the volatility gets magnified by the nature of that ecosystem. And, that's what we're in right now.
Exactly. I mean, I always say, don't tell me you bought Bitcoin because you wanted to be one of the 21 million Bitcoins, right? You bought it because you thought the price was going to go up. And I always look at it as it's a trader's market. And I think Bitcoin is important, but I think that a lot of the people that own it, if not way and the vast majority of the people that own it, they own it purely for price action, right?
Oh, right. Yes.
They're not owning Bitcoin because they want to own just to keep the Bitcoin. And that's why I think that you see these types of moves, because if you're losing money anywhere else, I don't know about you, Blue, but anytime I'm losing anywhere else in my portfolio, I sell the weak hand. If it's not performing, I got to dump it. And, and like you said, it's such a momentum asset class to where when it's going up, it goes up way more than you think. And the same thing for the downside.
Yeah, I think you nailed it.
Final thoughts today, Blue, before we let you go. I think just summarize to all the traders out there kind of what's happened this past week. We didn't even talk about what the ECB did. We talked about the Fed. I don't think we need to get too much into that, but I think just summarize what this week represents for the markets and what traders should be looking for when it comes to news and data and things that you think possibly could be leading the Fed and the ECB to take more or less action.
Well, I think, in the short term, what we have to realize is what happened over the last week or so is the narrative changed. The inflation data pushed the narrative toward inflation as a longer-term problem and the Fed's behind. The Fed then reacted to that and is playing catch up, but they did a pretty aggressive move, and they're likely to do another one. And so what we're really watching is who's controlling that narrative. And right now, we're in the place where the Fed is the most aggressive central bank out there of the majors, the ECB and the Bank of Japan. So I keep my eye, if I were a trader, I'd also be looking at currencies, because when you get divergences in central banks, you can get action in currencies. If you think the interest rates are going too high too fast, you can get action in equities. But if you think they're just going to go to neutral, which is where they'll be, between August and September, the Fed, then if you like my automobile analogy, you're coasting. So you don't really have to have a recession. So, we got a lot to think about out there. Traders are going to have a lot of opportunity.
Yeah, Blue, and thank you so much for your insight. There's a lot of opportunity, and there's a lot yet to be told in this story, and we'll be tuning in to a lot of your commentary. I love the stuff that you do at CME Group. You guys can follow Blue at CME Group on Twitter. And then, Blue, where is there any specific link or page? I know that I get a lot of your papers and stuff that's it's being written just by going through CME's Twitter feed or just going to the site. But is there a specific link people should be checking out?
They can go on the CME website and look for the education section, and they'll find a lot of our research as well as some other research. So it's all there.
All right, everybody. I highly recommend you check it out. And Blue, thank you again so much for joining me.
Thank you. Always good.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.